Hey there, Smile Spitzer from Superior Lending. Hope life is good for you right now. Um, today, oops, all over the place. Wanted to talk to you about student loans, but the first thing is, where are the rates at? So we mentioned this big, huge bar right here dropping down, getting ugly. That was from talking of inflation being noticeable and the Federal Reserve reacting to that. Also, they spoke of raising the federal funds rate sooner. And again, that doesn't translate to mortgage rates, but the mortgage rates price in anticipating that move. That's why we saw this big red bar right here that made rates a little bit worse. And then the other thing is the Federal Reserve talked about slowing down and tapering off on buying mortgage-backed securities. The buying of mortgage-backed securities keeps rates artificially low. Since that point, we've improved a bit in our rates. They are still fabulous. I mean, I'm still quoting people 2.75 on purchases that have excellent credit. Rates are still great. So, um, yeah, even though they're a little bit worse, they're still great. All right, I want to talk about student loans. So years ago, it was assumed that if your student loan was in deferment or forbearance, that you could exclude the payments on those and qualify for a mortgage. Things have changed quite a bit on there. So I want to walk you through so you understand what we're dealing with. And this is an ever-changing area. I'll point it out here in a minute, but just this week we had a change in the FHA student loans. So first I want to talk about conventional. Um, if a loan is deferred or in forbearance, and we've seen a lot of forbearance happen lately, you need to know that whatever the balance is, let's say $100,000 of student loans, we will count 1% for a Fannie Mae loan or $1,000. You need to have a loan officer smart enough to know and understand that if you took that file to a Freddie Mac loan, you'd only have to count $500 a month as the payment. Um, the other part that you need to be aware of is income-based repayment. We'll talk about this IDR. So income-based repayment is where you say to the student loan companies, your federal student loans, you say, hey, I am not making enough money to pay back these things back. It's an annual application that people make. And if you make that application, it is approved. You don't have to make those student loan payments for that year. If you present that letter to the lender, even if you only have 2 months left on that IDR, we can exclude the student loans. But it has to be done on a Fannie Mae loan. If you tried to do that on a Freddie Mac loan, they would make you count 0.5% of the loan balance as the payment. So, yeah, please be aware of that. And I should clear up right here, 1% or 0.5%. This is when we don't have a payment that shows for student loans on a credit report. If there is a payment listed on the credit report, we follow that. All right, let's talk about FHA. And like I mentioned, this just changed this week. So we'll divide it into two categories. Is the payment showing above on the credit report above zero, or is it showing as not showing or showing zero? So if there is an outstanding, if it's at zero or there is no payment, the new guideline is 0.5%. It used to be 1%, so 0.5%. If they are in an FHA does not do income-based repayment, so it's 0.5%. Now, if there's a payment showing on the credit report, FHA will follow what that payment is. But if there's no payment showing, we calculate 0.5%. VA loans. So VA does not ignore deferred or forbearance loans. They make you calculate a payment. And they have a formula for doing that. I'm not going to spend a lot of time on it. You can pause it and look at this, but it makes you do 5% divided by 12, gives, so $100,000 of student loans would give you a monthly payment of $416. That would be used if there is no payment showing or you're deferred or in forbearance on there. Income-based repayment, that works. Now USDA. There's a lot of info I'm going to throw up here. I'm not going to go through it in detail other than fixed payment loans. They will follow the payment or they will calculate it, and they've done a temporary adjustment here, but everybody believes it will become permanent, is the 0.5%. So that's kind of the calculations for the deferment and forbearance student loans is 0.5%. They do not do income based on there. So those are there. The one additional one I didn't throw up here is jumbo loans. Those can change from lender to lender, but typically they will calculate at 1.5% of the student loan balance. So a little bit higher, a little more conservative. Why does all this matter? Man, you need to talk to your clients, because many times they come in and they think they're doing really great on what they're earning and what their monthly expenses are because their student loans are in forbearance. Well, we still have to count payments for them to qualify. And as you can see, even 0.5% or 1% is a really hefty amount and can move those debt ratios all over the place. The income-based repayment is a big deal. That really can help a lot of clients on the conventional loans by being able to get an income-based repayment plan. Let me know if you have questions on these. You need to be aware of this. And also, as I mentioned, it is changing quite frequently on this. FHA just changed this week. Let's see, what else? All right. In closing, let me know if you have any questions. We love helping the clients understand what they're doing. We want to make sure they understand all the fees, and we want to make sure every client has some options when they're getting their mortgage. Let me know if you have questions. Have a great week. Miles Pitcher, Superior Lending.